The million-dollar question. Sylvia, should I take a fixed rate or a variable rate? Well, my answer to you will be, it depends. Let's define what a fixed rate is. A fixed rate is a mortgage product where the rate stays exactly the same for the entire term of your mortgage. What that means is your payment stays exactly the same. Clients who love fixed rate products, why they pick a fixed rate product is because it's good for budgeting. The payment stays exactly the same, so it's good for young families or growing families with young kids that have unknown childcare costs. So they would be a good candidate for a fixed rate. Another client that would be a good candidate for a fixed rate product would be someone who's really, really into budgeting, who really wants to know their numbers every single month and be able to budget their expenses. Two things to know about fixed rates. Fixed rate penalties can be very, very, very high, especially if you're with one of the 5 big banks. So be aware of that, because that's where a lot of the lenders make a lot of their money, is with penalties on fixed rates. The second thing to know about fixed rates is you can't go from a fixed rate to a variable rate without paying that high penalty. Okay, let's talk about a variable rate product. So variable rate, just like the product says, it varies. Well, what does it vary with? Well, it varies with the Bank of Canada prime rate. The Bank of Canada gets together 8 times a year, and the Bank of Canada can decide, it's pre-scheduled date by the way, and the Bank of Canada can decide whether they're going to increase the rate by a quarter point, decrease the rate by a quarter point, or keep the rate exactly the same. As prime changes, therefore your rate will change, and therefore your payment will change. Who would be a good person to go into a variable rate product? Well, it would be good for an individual who understands their budget, who has a higher budget than the bare minimum. So for example, let's just say it is a family with a double income, and their budget for their mortgage is $2,500, but they can totally afford $3,000 a month. So they have a $500 a month buffer. And because they have a $500 a month buffer, that if prime does increase over the term of their mortgage, it won't be payment shock. So for me, the most important part of a variable is payment shock. I don't want someone going into a variable rate product and then as prime increases, they switch over into a fixed rate that could potentially be higher. Now, 2 things to know about variable rates. You can always switch from a variable rate to a fixed rate. The key thing to know about is your conversion. When you convert from a variable into a fixed, there are lenders out there that will give you their discounted rate. But there are many lenders out there that will give you their conversion rate. So what that means is when you convert from variable to fixed, they're going to give you a higher rate, better than if a new client were to come in. The second thing to know about variable rates is variable rate penalties are dirt cheap. So they're only at 3 months interest compared to a fixed rate. You want a second opinion on your current mortgage? Do give me a call, book a time. There'll be a link in the post, and you can book a time. All it takes is a 10-minute discovery call to see what we can do to help you out with your mortgage. Thanks so much for listening. Take care. Bye now.